So let's talk about the Prism report. That's our traditional benchmarking report. We rolled it out early in 2020. It's a total fee benchmarking report. It looks at plans of a similar size, customizable bands, can be run annually or on demand. It's really unlimited use if you're a subscriber to this tool. Limited data points are required, only 5 or 6. That's where we get our 2-minute benchmark from. So it's quick and simple. And it's a very low cost, and we'll be sharing some of the cost purposes later. This has been wildly popular over the last year. Over 30,000 Prism reports were created over the past 12 months. So advisors have really used this, especially during the past year in the pandemic, to one, bring value to their clients, and 2, start conversations with prospects. And now our new Prism 365 tool looks at advisory fees and services. Again, it's really easy to use. The database comes from over 1,000 advisors, and it's the only report in the industry that benchmarks the frequency of the services that are delivered from advisors. And again, it's also low cost. Either report, you can sign up directly at PlanFees.com. We also have, you may have access to it through a broker-dealer or RIA, depending on if they bought it at enterprise level. The Prism tool, the total fee benchmarking, or the Prism 365, the advisor fee benchmarking, are both. You can sign up for one or the other at $49 a month for either one, or as a bundle for $69 a month. Really easy to sign up at PlanFees.com. But today's webinar, we really wanted to focus on the Prism 365 survey and benchmarking report. So like I said, this data, we went out over through the end of 2020 and surveyed over 1,000 advisors. We got fee data from over 20,000 plans, and the service model and service frequency from over 10,000 plans. And here's a couple key trends from that report. When we looked at the advisor types, maybe it's kind of self-selecting of the folks that we work with, the folks that utilize PlanFees, but 30% are RIAs, only 11% are broker-dealer only reps, and 56% are hybrid. And when it comes to the firm size of each one of those who responded to our survey, you had a vast majority, over 75% of those respondents with 1 to 5 plans, and then about another 24% or so with 6 or more staff. From a revenue perspective, we looked at this, the folks that responded to the survey, 45%, so nearly half, have under $500,000 in firm-wide revenue in the retirement space, and 55% have over $500,000, with a couple, a nice percentage, 13 and 15%, over $1 million or over $2 million. And from a revenue type perspective, this is something that we found pretty interesting, was that almost 75%, or 3/4 of revenue on average, came from a fee for service instead of a commission-based model. So that we see this as a trend that's really growing, and this is something that we're going to be tracking over time here at PlanFees. From a plan perspective, the folks who responded to the survey, you see it's a nice bell curve, 25 to 100 plans being the normative mean. This is labeled revenue, but this should really say assets under management. And you see a majority of those assets under management coming in the under 250 million or under 500 million, but you do have quite a good number of larger firms with $500 million or more. And then a really nice broad spectrum of respondents in terms of the plan size ranges that they service. So again, you see a lot in the under 20, but you see 50% or more of the respondents of the survey do work over 20, over 25 million. That starts to drop off over 50 million, but you do have a lot of large plan advisors who responded to the survey. And then kind of getting into the meat of this, we asked all the respondents of our survey what their average fees are in certain plan ranges. So under 1 million, 1 to 2.5, 2.5 to 5, et cetera, all the way up to over 100 million. And we asked both dollar amount and basis point. And so you see here the purple graph, a nice expected downward slope. We've compared this to our other databases that we have. We've compared it to the the 20 or 30,000 examples that we've got through the PlanFees annual benchmarking tool, and compared it to other industry sources. Very accurate, very comparative, and what it shows is that the majority of the folks who responded to this have a robust service model, so that's what we also saw. The Prism365 survey evaluated firms on 15 points, so in 5 core categories: investments, RFP benchmarking, fiduciary governance, employee engagement, as well as those fees. And we asked in each category whether a service was included in the base fee, had an additional charge, or was not offered, and then in many cases asked for the frequency of those services. And we're going to get and show a couple examples of what that looks like. From an investment committee meeting frequency, this is an area, when we looked at the benchmarking reports that were out there in the marketplace, one issue that came up consistently from the advisors that we talked to is that they say, yeah, we see that 90% or 95% of advisors include this service, but they, as an advisor, were saying, I include this at a higher frequency. I'm meeting with my clients semi-annually or quarterly, whereas a lot of advisors might have a low service model. So that's where we focus this report, is really to be a lot about frequency. And so you see here a nice distribution when it comes to the purple would be an annual investment committee meeting, the light teal would be semi-annual, and the blue would be quarterly. And we see probably the expected distribution in terms of frequency as plans get bigger. Where you see the opportunity is in the low middle market, I'd say the $5 to $15 million, where you see a nice even distribution between annual, quarterly, and semi-annually. So this is an area that advisors can focus in. If they bring a high frequent service model to clients of that size, you can maybe disrupt a current relationship with an advisor. Concurrently, if you do offer a lower service model in terms of frequency, because that's just what you provide, you can also say, hey, this is the norm. There's 40% or 45% offer the same service model, so I'm in line with the marketplace. We asked about RFP and fee benchmarking frequency. So we not only asked, but the frequency of a live bid RFP, which is very important. You see a big distribution in terms of every 3 or 4 or 5 years are not offered at all. But when we look at annual fee benchmarking, obviously that's where PlanFees thrives, but we see a good amount of folks in the smaller market who don't even offer this service. And even those who do say they offer this service, what we find is that almost 60% of advisors aren't even delivering an annual fee benchmarking because it's too cumbersome or too expensive. So that's one area that you can use PlanFees for. We talked about fiduciary fitness or fiduciary process review. We talked about the frequency and delivery of that. This is an area where a lot of advisors say they do this. They might give a plan review, but this is also, if you have a robust fiduciary governance and education model, if you're using something like Hero 7 or CFEX or through RPAG, you have a nice model. This is something where you can disrupt a current relationship. And then what we found the most interesting was the education and financial wellness. So the most commonly delivered frequency of employee education or enrollment meetings was between 1 and 4 days, with 1, 2, and 4 being the most common. But you do see more days, between 5 and 9, or even 10 days or more offered at a larger plan level. But you still see a lot of advisors, a good percentage of probably nearly 15 or 20% at the smaller end, who don't provide employee education. So if you have this capability, this is an area where you can create a wedge. And then I wanted to segment this kind of by plan count. So advisors with 0 to 24, 25 to 99, 100 plans or more in terms of financial wellness program delivery. And this is where we found the biggest new trend was that as advisors got larger, they were not relying on the record keeper to deliver a financial wellness or financial education program, but instead they were using their own proprietary or third-party system at a more frequent basis. So the larger advisors out there have invested the time to create their own proprietary system or leverage a third-party tool like a Questus or RPAG or Ramsey Smart Dollar. There's a lot of programs out there. They usually come at a premium cost, but they also come at a higher effective rate. And we're seeing that even advisors with more plans are bringing those solutions to the smaller market, even under $1 million. So that's a big trend that we'll be monitoring as we continue these benchmarking.